G'day everyone, Greg Canavan here. In today's conversation with Ryan Dintz, we're going to discuss in further detail one of the key recommendations we've made for our new money investor product this year. I hope you enjoy it. What was next on our recommendation list? I think we were talking stable coins, weren't we?
Yeah, so we went from Bitcoin and gold to the idea of stable coins and how to generate interest from them. So just if you recall, stable coins are like the crypto version of digital dollars. There's different types of stablecoin. They're generated different ways. But we came up with a concept of allowing you to do it through the Ember Fund app, and we spoke to them and got them to create a little stablecoin yield strategy for us, which means you could put some money in through the app and basically generate interest on what are essentially US dollar savings. So since we launched that, the average return has been about 6.8%, but that's fluctuated wildly. So the rates there are determined by the free market. So when crypto markets are bullish and people want to borrow more stable coins, the interest rate goes up. And then in times like now where everyone's got bearish, everyone has to pay back their debts quickly and then demand goes down. So right now, when I checked before this call, we're at about 2.7% interest rate. And that's invested across two different stable coins in two different decentralized platforms. So the way we designed that was to try and, diversify across the platforms and across the type of stablecoin.
Hey, out of interest, what was the interest rate on that stablecoin strategy around the lows? I think it was back in April, earlier on this year, when we had that real drawdown to around 30,000.
It got Bitcoin. Just from checking the app, because I've got some money in it as well. It got it was less than 2%. It was 1.5, probably at the low, but that was at the ultra low. It came back fairly quickly. So you just got to remember, these interest rates, unlike the ones that we operate in the normal banking world, are not determined by anyone. They're purely determined by the forces of supply and demand. The way I was
going to say, it's almost like it's a sentiment indicator. The lower the interest rate gets, the lower the closer to Bitcoin is to potentially a bottom.
Yeah, look, I don't do this myself, but I know some quant traders who build models around trading Bitcoin and crypto, and they function in interest rate yields on different crypto products as trying to pick highs and lows. So when interest rates are really high, usually say this is a blow off top, and vice versa on the lows. So it's definitely a good indicator. But the way I look at this is more of a long-term investment. Like I said, I've got some money in it myself. Is it's stable. So it's not like investing Bitcoin where it's going up and down a lot. It's generally sticking
the stable coins,
a US dollar. So the way I think about this as an Australian investor, well, if I'm getting an average of 6.8% on my money in US dollars, it's a lot better than what I could get in the bank, first of all. Plus, I'm sort of using it as a bit of a hedge because I've got some of my money in US dollars. So if there is a general economic panic, generally the Australian dollar goes down against the US dollar. And I think we've said this before.
We've seen that this year as well. I mean, the US dollar's been in a bull market nearly for the 6 months of this year.
So already I think I'm making probably just as much in the currency gains as I am in the interest rate, which is good because I think it was about 75 or 76 cents when I first went in. Now we're about 71 cents AU dollar to US dollar. But as we've talked about in the sort of the headline of this service, if there is a calamity, a big economic calamity, we will get a huge flight to the US dollar as well. That'll be one of the big signs that people are worried. That's the safe haven asset. Bitcoin will sell off, gold will sell off, stock markets will sell off, other assets, bonds might sell off, and we'll see the US dollar go up. So the way I look at this as part of my portfolio, I'm not putting all my money in this, I'm just putting it up apart, is to say, well, one, it's savings that I can tap into if I need them. There's a little bit of friction there. It's not a bank account, but I can do it. I can get them out anytime. I get a decent interest rate while I'm sitting there, and it sort of acts as an Australian dollar hedge to my other assets. And if crypto markets are down, then at least I've got some, if I want to put more money into crypto, I can always, tap into that and add from there as well, even through the Ember Fund app. So I think it's an interesting product to look at. Again, it's not, if crypto goes on to glory, this is not the one you want to have your long-term money in because you're not going to get the gains. This is always, remember, this is the crypto equivalent of a bank account.
Yeah, it's income.
But it's in US dollars. So I think it's going pretty well so far. I don't know how many people have used it or not used it. I've not heard any feedback Remember
Hey, do you
fund?
think we just talked about central bank digital currencies? Do you think they could be a threat to, I guess, the stablecoin ecosystem? Would there be a need for stablecoins if we actually have an electronic US dollar that's created by the US government?
That's an interesting question. Because that is on the minds of people right now. Stable coins are one of the first thing regulators in America are looking at because it is a direct competitor to the US dollar, which is something they would be worried about. So I'd look at this in two ways. I think there are regulated stable coins that exist in the US. One's called USDC.
Yep.
Now it might be a threat to them, but there are a lot of decentralized US dollars, which is the sort of equivalent of a shadow US dollar market. Now, some of them are synthetically created, so they're not actually backed by US dollars necessarily. They might be backed by other crypto assets. One of them is called DAI, DAI. Mm-hmm. And I just read the other day that some of these offshore stable coins, like Tether even, which gets a lot of bad press, they're used in a lot of countries that maybe aren't on the best relations with America. So there are other countries, Iranians or North Koreans or other countries that maybe don't want their stable coins to be within the grasp of American regulators. They're happy to use the other versions of stable coins to still have that dollar exposure. Now, they might come with some risks in terms of volatility. They might not maintain their peg quite as accurately. But if you're living in a country that you're going to have your bank account closed, maybe that's a viable alternative. The last point I would say is, remember, these spaces are always innovating, and this is the beauty of free markets driving these things. There are a few stablecoin projects I follow that are looking to create a stablecoin that is stable in terms of its purchasing power, not necessarily the US dollar. So trying to create like a sort of inflation hedge stable coin. I don't know how they're going to do this in its early days, but that would be interesting because then you're not aligning yourself with the US dollar, so you're not within that regulatory regime. You're just trying to create an asset which somehow manages to, maintain an inflation hedge. And it'll be interesting to see. These will be experiments, and they might not work, but the innovation is really exciting to watch.
Yeah, it's interesting. Thanks very much for listening. I hope you enjoyed that little snippet of New Money Investor. If you'd like to become a subscriber, please click on the link below. Thanks a lot.